I'm trying to write my book, okay? And each one of these things is going to be a little subject in the book. And now I'm going to, because of what we're doing together, we'll have a little library on this. In that consolidation model, it I have every single other time I have done this, I have used an index function. And I suppose I'll begin by showing you just the mistake I made and how arrogant was I to think, oh, we can do this in an easier way. The session when we had the time before last, when we went over the negative repayment, or the situation where you take cash flow divided by DSCR and you get a number, and that number is greater than less than the interest expense itself, which means you could have a really high interest rate, or more important, you could have one period with really low cash flows, like a period where the sun isn't shining, and the other period has really high sunshine, or batteries. To try to suggest there's some fancy little trick you can do, and some elegant thing you can do to make it all work really fast, was so wrong. So I'm gonna when we do this consolidation, we have to do this index thing, and then I'm going to move to corporate finance. I still don't quite know how many people are interested in kind of general modeling issues or general financing issues versus project finance versus corporate finance. And this helps me a lot, having these Saturday sessions. It really does. Because if I want to explain corporate finance, project finance rather, to somebody, I think, okay, let's begin by talking about corporate finance and the problems with corporate finance and the problems with finance in general. And project finance solves a whole lot of them, with one gigantic exception, is that we can't measure performance. We can't measure the IRR on a period by period by period level, or this return on invested capital doesn't make any sense. Now, this McKinsey book that I read a few times, not really read, but looked over a few times at least. When I first read it, I thought, oh, this defines the whole world. This is this is dramatic. This must have been 20 years now. And I thought, oh man. And because they said, oh, all valuation comes down to three things. It comes down to what kind of return you're earning. And they suggest, because they love kind of this Miller and Modigliani idea, they said, don't distort things by the capital structure, use return on invested capital, use pure cash flow. And if a company that is going to have a high market value is one day or another going to have a high rate of return that's way above their cost of capital. That's the only way you can increase the value of your company can be more than the amount you put in. That's the only way the price to book ratio can be above one. And then if you have something like this, you grow it. And then if you have some crappy investments that aren't working very well, you're supposed to get out of it. They don't really emphasize that part enough, which I think is a gigantic part of business. Okay, my uncle with his handbag, he has to get out. He's an entrepreneur. I respect him. And the biggest thing he does is he gets out of crappy businesses and tries to make investments, whether it's in advertising or an internet website or something else, that will be profitable. He doesn't even know he's doing that, but that's what real business is all about. So we're going to demonstrate that in a model. And one of the things I don't quite understand, again, I've got little hangups all over the place, but why in some kind of business school class, why they wouldn't start with a little analysis that shows the return, growth, and cost of capital, and you can explain so much by these things. Now, then we're going to go back to our consolidated model, because that's now a corporation almost. And I don't know if you remember, but I did this so quickly, it was ridiculous. And I bet you nobody gave one crap about that at all, where I said, oh, let's compute this thing called economic depreciation, where we measure the depreciation. It's kind of based on the IRR itself. We say the depreciation is the change in the value of the project. It's not just some arbitrary straight line thing. And when we use the IRR itself to measure, and we take the IRR and say, here's the value of the project, period by period, it's the net present value using this IRR. And then we use that for depreciation. Magically, we get the IRR itself to be the return on invested capital. And so we can prove, which is of course not at all in, none of this stuff is really in this McKinsey book, by the way. I'm kind of, well, that was stupid to say, but the basic principle is there, but this market to book ratio isn't there. And the fact that the IRR, pre-tax IRR, and the ROIC on a pre-tax basis are exactly the same is not there. And that's the real measure of value. And it's so cool now, after what we did last week and Nikolai typed all that stuff in, now we can really demonstrate that fundamental idea with the corporate model. Now, after we do that, and I'm going to introduce things a little, and then we'll get into the finance. Please don't worry if you're in project finance, because we're going to do a little bit more interesting and complicated things in our model. And one of the things which, again, it drove me crazy at first, the CFO of the project I was working on said, oh, no, you got to do this month by month, because some debt issues are, the interest is paid in March, some it's July, some it's whatever, some other month. And we want to get that repayment and interest. We really want to understand that on a monthly basis. And our model is all monthly. Oops, sorry. Our model is, I think somebody has a microphone on, sorry about that. Our model is all monthly, but in reality, the way the bank works is you don't pay the debt off monthly and you don't pay the interest monthly. And when you compute the DSCR, you do it on a semi-annual basis typically. It could be quarterly or something else. And how do we take a monthly model, which is pretty easy to do? We did that. And how do we make it into a semi-annual model? And to do that, I used to try with this offset and this sum offset. We can even show you how to do the sum offset a little bit. But that for me is somewhere in between making a complete mess of the model and just being a show off. And if you set up a flag correctly, it's so much easier to do this analysis with sum if. And I want to show you that. And for me, that's an important little Excel tool to use. Now, the other thing I'm going to show you is, we're starting as, and I don't know if this is deteriorating or not. We're starting to use macros a lot. I've got to finish sentences here. We're starting to use macros more and more. I don't want, the worst thing to do is to start using macros when you don't have to. That's horrible. But there was this thing where we consolidated the sheets, and we used the indirect function to consolidate the sheets. And when we did that, the indirect function does not work with that sum where you put sum start, and now I can almost remember two dots and then end and then exclamation point, and then you go in between the start and the end, and it sums everything in between those sheets. By the way, you could just move a project out to make it after the end sheet, so you could put projects back in and out of the consolidation really easy if you did that. In fact, let's do that. But that consolidate function, it doesn't work. It would be wonderful. It would work with indirect. I cannot get it to work with indirect. I don't think it works with indirect. And then the final thing for me, which is a really big deal, and maybe I'll go to that one right now. So, no, I'm not. I'm going to finish the discussion. We talked about copy and paste macros. And I have, some people might have even seen me blabber on about this about 10 years ago when I was taking a shower. I thought, oh man, we fixed this goal seek. We did this thing called a function. We wanted to make the goal seek like a sum function. So instead of pressing that button and letting it do it, we made a little function where it does it automatically. And wouldn't that be cool? So we kind of I did a little bit of iteration, and that worked. You can make it work. And then I said, well, that's you can kind of solve, where we have that difference in the copy and paste, that difference, you can kind of make the circular reference be solved with a goal seek. And then I said, no, we don't need a goal seek for that. We just got to iterate around a little bit, like that copy and paste thing does. So we're going to put a copy and paste into the model and show, and here's what's happened recently. There's a person named Mr. I think it's Hatmaker, who's brilliant at this stuff. Hetty had a little argument with him, but that's beside the point. I talked to him and he said, oh, the big problem nowadays is these models are getting too big. Our model is getting really, really big. And when we solve this circular reference with this thing called a UDF, which I want to show you now, I've been reluctant to do this because in the real world, I think you'll use copy and paste most of the time. That's fine, whatever. And when you use copy and paste, then you can't really do a goal seek. You can't really do a data table. You have to press a button, all these problems. But if you put a copy block and then a paste block in there, it's not that bad, really. The problem is when you have these big models, and Mr. Hatmaker said, oh, the big problem in the world these days is the models are getting big, and our model is getting really, really big. Our model, because we just consolidated all these things, and because we had to do this monthly, because if we didn't do it monthly, we couldn't put individual months when new projects began. It's getting pretty big. And then when you use that copy and paste in a big model, it slows things down. So I did a little experiment where we're going to solve the circular reference, which is a natural problem. I'm repeating myself. I think I said last time, anybody who says, oh, I've heard consultants say, oh, there's no such thing as copy and paste in the real world. You don't have to go and iterate in the real world. That's not exactly true. A lot of things you do, you have to go around. Oh, I'm going to try this, but then I do this, and I do have to go around and around a little bit. If there's a problem like that, we could use the iteration button, number one, the copy and paste, number two, or number three, this UDF I'm going to show you. I'm talking too much. Maybe we won't have that much time to get into this. But the effect on the speed of the model nowadays is dramatic. And if you have these big models and you have to sit there and wait, you don't know how long 2 minutes or 3 minutes in Excel is. It's forever sitting on the computer and just waiting and watching it. How horrible is that? We're going to show you in this example, and I just finished this the other night, that it really saves a dramatic amount of time to use a UDF, and I'll try to explain why, okay? So let me just I'm gonna open our model before we get started and just show you a few things in our model. And I don't know if you have to do this. So this is,
If you're intending to share,
oh
then please.
shit, I'm not sharing the screen. Oh damn. Oh damn it. I'm gonna, oh thank you. Oh God damn. See, I got too nervous. Oh man. I am so sorry. I have what I was doing is just looking at a PowerPoint slide before. I'm so sorry. Thank you. Oh man, what, this was what I just looked at before. I just looked at this macro, and this was what we have, this time start here. Oh God, I'm gonna have to now edit this file again when I send it to you. And then our seconds taken is this time. This is this variable in a VBA, and we can't compare it to the beginning time we started with. And that's why I said we multiplied by 60, 60, and 24. And this is where we copy the sheet. This is our big one where we copy one sheet to another to another. But when we were copying that sheet, if I change that scenario from 1 to 2 to 3 to 4, it's changing that in all the models. Every single model is having exactly the same sheet. So instead of doing that, oh, thank you for telling me, I can't believe that. In our input C, this was, remember, we said, all you have to do is change this number, and then we use this number. And I, in my arrogant way, I thought, crap, I can do that. And of course I couldn't. And so now at the very bottom, I just added one more thing where I said, let's try different methods for resolving a circular reference. And if I put method number 4 in, we have no circular reference. I cheated and I took the whole thing away. And that's our kind of baseline. If I use 1, I'm going to use this iteration method. 2, a copy and paste method. 3, our UDF method, and 4, our other method. Okay. And then the other thing that I got wrong as well, the input S, that's a big deal. As you get more and more advanced, oh, look at this, because I put number 1 in, I need to, let me put number 3 in for now. Because in our input S, so many of the variables change when you change the time series, and that didn't work either. I made a mistake on that one too, and let me show you how I fixed this mistake. Now, before these all just came from the input C. So the way we did it before, we just had a input C like this, and we just took the capacity or something of the solar. I think that's what it was here. Well, which one is this? Well, we had some battery capacity. I'll put it, we had this. And what you need to do is instead take the whole, this is really number 26, not number 34. But so instead of doing this, what you need to do is put a little code up here. And if this template model is number 2, then we take the second one. If it's 3, we take the third one. And I thought, man, we don't have to do that. And I was so wrong. It was it was really embarrassing. So instead of doing this, you put index, and then this was number 26. And when you put index, I think this was our solar capacity, you take the whole thing. Now, I find absolutely nothing wrong with going all the way to the end. And the way I know that is, remember, I just showed you that timer thing. If you start testing that and saying, let's put it, instead of XFD, let's put it to AA or something like that. And let's make a gigantic model. Let's repeat it 1,000 times and then another 1,000 times and see if it takes longer, if we're going all the way to the end. Now, Brian or this Mr. Hatmaker would say, oh, no, you don't have to do that. You theoretically, you know what Excel is doing and all that stuff. It didn't make any difference if I went all the way to the end like that. And then you go to the model and you take this button like this, and you have to kind of do that with every single input, with one exception, actually. And so when you do that, now if I press number 2, then it takes the second one. And then once I copy it, I'm going to keep this as number 1, number 2, and number 3. Whereas if this number 1 and number 2 would always be going back to our input C thing. Whoops, no, I'm kind of messed up. If this would be going all the way up here, then after I copy the file and start changing this, okay, let's put it back to number 1 here. Then it's going to make them all number 1. And then I copy this, and I thought I've done it cool by copying this, and then they'll all be number 2 if that's the scenario. So this has to be just a regular kind of hard-coded number. Let's put it as number 3. And then as we go around and around, instead of changing that scenario number like we did before, we just changed this thing that was in did I do this right? Yes, create sheets here. I can't believe I didn't share the screen. God, you just put that in, you change that E1. Now I could have made this a range name, but I said, no, we're not going to make that a range name. Okay, because if you made it a range name, every time you copy the sheet, it'll make 12 range names that have the same thing, and they have a different sheet next to the range names, and that's all okay. Then when you get to the input S, the way normally what I do with the input S is I would normally say, okay, this code number here, right now it comes from this inflation code. So right now I have different code numbers, and those code numbers would drive every time. I should have done this down here as well, but every time you have an input S and you want to put different scenarios, which we always want to make is different scenarios, then if this code number changes, so I just kind of showed you, okay, we have the solar, that's code number 1. We take that up here, and then I did a little conditional formatting. That's pretty easy to do. I'm not going to waste too much time on that unless somebody wants me to. Okay, so you could do that, but that has the same problem. If now I want to make this template model, I want to not always go back to, because right now it's going to be taking it it's going to be using this code number, and I want it to be able to use different code numbers here depending on the scenario. And perhaps I didn't explain that very well because for me it's a little complicated. So on this one, it's kind of a pain. I had to use an indirect, and I had to say, okay, this indirect, what we want to do is I'll do it over here. If we want to take this thing up here, I want to take an index again on this one, and I hope I'm emphasizing one thing to you, and that's using the index and the lookup is a big deal. So this time, this 3 depends on this number, I hope. I should have colored it. That 3 depends on this number, not on changing the overall scenario. And then if you put equal index, sorry, let me do it over here, equal index. And then I'm gonna first with the index take these 3 things, and then I'm gonna have to copy that across. And then I go to this number over here. Okay. What I'm going to have to do is when I change this, I think, well, I used the indirect function. Oh, I used it with lookup instead of index. Sorry about that. Okay, I think you could have done it with index as well, but you need to use the indirect function to grab either one, two, or three from that other sheet. Okay. So those are the mistakes I made. Now, when I made those mistakes, then I said, okay, here's what I did. Let's go over to this one. And we put our project by project statistics. And when Nikolai said, oh, put what do you call that? The exclamation point in there. What I did, this is the project IRR. And what I'm going to do now is I'm going to go to each, just to remind you how this works, I'm going to go to each of these sheets and find when our this one, I'll find F7. I'm going to find F7 in all of our sheets. Okay, and I'm going to put equal indirect. No, let's do what he did. I'm going to, how did we do this? G, can I do this? And then he put E, we put E2, and I'm going to this time say, oh, let's put 7. It was 7, I hope, what we did this, and it was, what was it? Was it F7? It was this one. I said, let's get this one, and I wasn't that bad, okay? So let's get, and on this one, let's put it over here. So we get this one, and then we have our little wonderful thing. And the way that indirect function works, again, I've gone through 2 stages of my thinking about this. I used to use it and like it, and then I went to the stage where it slows down Excel, and it does slow down Excel. It's not an efficient function, apparently, for the fancy people who use it. But, and maybe an auditor would even complain about it, but it's just so wonderful. And then we said, oh, let's use this one like this. And then remember Shift F3, and then we can put the dates we have for our different projects. So what I did here was I changed the dates around and made this last one have a much higher IRR than the rest of them. I just purposely kind of did that. And I said, okay, this is kind of corporate finance. What you're really doing in valuing any company, these are the project IRRs and these are the COD dates. Number one, you can grab all the stuff you want and do it really pretty quickly. By the way, if you take up here, if I put control spacebar and then shift alternate and right arrow, if I don't want to show these, I can just do that, and of course you can put the plus or minus or 1 or 2 here and take that away. The idea, the finance idea here was what you're really doing when you're valuing a company, you're valuing all of your existing projects. That's what you're doing. And then you're coming up with this terminal value because your boss says, oh, our company is going to last forever. And then the real value comes from this. Can I make, or in the long run, do I have such smart management? Well, the management's going to all die and quit and retire and all that. But do I have such kind of special management in place and corporate cultures in place or whatever in the heck that is, that I can make a much higher return relative to our cost of capital in the real long run? That's what you're really doing with terminal value. And I don't see how you can understand the whole business of terminal value without kind of understanding project by project. All right, and then this is where we're gonna start. I'm gonna move over to somebody else and have them do it. But before we do that, so what I did here was I haven't done our famous 3-statement models, which makes me throw up. When we did our project by project, okay, I went through this relatively quickly because I know you're probably never going to use it and you're never going to think about it. we had a project IRR. Where's our project IRR? So up here somewhere, we got our, that's where we started. And for people who might be just kind of starting on modeling, how could you not have this as the very first number in the whole thing you really compute? All you need is EBITDA and CapEx, and then we get our project IRR. And once we have our project IRR, the problem is if we put some straight line depreciation in our project IRR, I know I'm repeating this and I'm really sorry about this. When we have our return on invested capital, and I put this on a monthly basis and then annualize this later, and the problem is our IRR starts really low. This is month by month, and then it goes really high. And then I said, oh, okay, we can take the weighted average. And this, for me, it still is a little painful to do when I take the weighted average of all these returns, the weighted average of the returns, and I weight them using a discount rate that's the IRR itself. If you wanted to compute an IRR in a different way, or that thing we did on the very first session, you could compute it in a different way. When you take that weighted average, you get, and this is the, whoops, this is the sum product. When we weight the average, and we weight it based on both we weight it based on both the discount rate and also the amount of the investment, because the investment goes down. We're going to give a much lower weight to the IRR when the investment goes down. The weighted average IRR is exactly the same, then I have to annualize it, is exactly the same as this IRR we got here when we took month by month and then went down. Okay, so that's the idea. Now, if I'm gonna try to hurry up because we'll get into your sessions in just a minute. If I'm gonna open a file now, you have to go and steal this yourself. I shouldn't be giving this. I don't give this out anymore. Okay, if you go to the finance books and then you go to this book called Valuing, this McKinsey book. And I have a couple of copies of this. Let's use this one. Okay. Uh-oh. Okay. And I guess this is a little bit of an older version, but that doesn't matter. Okay. And this is this famous book. I've heard people say, oh, this is the Bible, whatever, the Bible of finance. Oh my God. If you go up here and put ROIC, okay, and if you look at ROIC exact matches, we have 622 exact matches of ROIC. And as you go down, you can see it's just everywhere. Okay, this is how you measure performance, and this is how you, oh, they had Fred's Hardware. I guess this is an older version. I remember Fred's Hardware, and then it explains what the ROIC is, and then you see how it's starting to compare the ROIC to the WACC. Okay, that's what they're starting to do here. Present value of economic profit is here. This is a good one here. Okay, and they put all these valuations here. So, and there is that what they do to compare the ROIC to the cost of capital is a very completely legitimate thing to do. Mathematically, we'll prove that in just a minute. In fact, you don't have to go through each one of these, because then if you go up to the top and press Control F and put WACC here, we only have 278 occurrences, but this is clearly this whole book, which in this case, where was the book? 769 pages. You can read this all, but it really boils down to this. Now, what they don't do, I cannot believe they don't do this. I can't believe this. Here, what I'm going to do is maybe what should I guess I'll do it here. Shift F11. Okay. There are two formulas in finance. One is value is equal to dividends or cash flow in the next period divided by the cost of capital minus the growth rate, WACC minus growth rate. I'm sorry, I'm doing this. I'm going to I'll put equal sequence. Whoops. And I was at first, I'm embarrassed to go over this sometimes. And then if I'll let's go to 500 periods, 500 years, okay? And when we do this evaluation, let's say we have a dividend of 100. And remember, I hope you can press, oh no, I don't have generic macros open. How could I not do that? Okay, I can say I don't have it open on purpose for you. Okay, and now I really think I'm curious for especially students, if there anybody here to tell me. I assume you go through some of this. If you take the NPV, let's put the K here is 6%. I'm purposely making it relatively low, and then you put if this one we don't have any growth, then you put NPV of 6%, and you get all of this over 500 years. That's forever, if that's okay. Okay, and this one, the present value is really in year zero, because we're starting in year zero. So that's why you need D1 up here. And if we use this formula right now, we could have just taken 100 divided by K, because we don't have any G here, and we would have got the same number. Now, if you would have put a growth rate in here, let's put a growth rate of 2% in here, and take our this one times 1.02 and just shift Control R. I hope you're saying, oh, that's pretty good to use that little stuff. Then we get this as our value. And so our value now is this 100 divided by 6 minus 2. Okay. I can't believe that. And then we get our value. That's our first value. The second formula is that I remember this formula from the 1970s. They said the growth rate, that's the growth rate depends on how much you invest. If you have a savings account, how much you invest, and then how much you leave in versus take out. So the growth rate it's your return, which is your growth. That's your basic return times 1 minus the dividend payout ratio. Okay. That's what the basic formula is. If the dividend payout ratio is 100% and you have a savings account, and as soon as you grow, as every year you take every little bit out that you've earned, your growth rate, you take that out, it will never grow. If you always leave it in, the growth rate and the return will be the same. That was our starting point for everything. And then if you return. I didn't spell it right. Who cares? So now, but that doesn't help us at all, because we want to put a growth rate in. So we want to reverse this formula around and say return. No, we're going to say 1 minus the dividend payout ratio is equal to G divided by R. Is that okay? I just made that. And then I just let's put then we just say dividend payout equals 1 minus G over R. But here's what you can do. Then you can start getting fancy, because instead of the value is equal to dividends, you put the value is equal to the earnings times the dividends divided by K minus G. Okay, and maybe you've all gone through this. Everybody, they should go through this right at the beginning. But E is the earnings, and I meant to put this to be dividend payout ratio. And then we substitute the dividend payout ratio, and you put value is equal to E times 1 minus G over R divided by K minus G. And then you can say value divided by E. So value divided by E, which is the price to earnings ratio, equals 1 minus G divided by R O E, and that it could be ROIC divided by K minus G. And then you can take that formula and make it into a whole bunch of other formulas. And that's the formula in that McKinsey book. Sorry about going a little bit more into kind of regular old corporate finance, but here's the deal with project finance. So right now, the problem is we can't use our ROIC anymore because it goes crazy. Because remember, if we used this, I'm sorry, up here, where was our ROIC? It was right here. You remember what we did? We went to insert, and after we went to insert, we made a spark line, and then we said, oh, I'm gonna kind of cheat and start over here, and I'll take and I guess we had a little bit of seasonality, and then it was going way too long here. And the problem is that ROIC is not our 0.58. So we can't use those wonderful corporate finance ratios in project finance because, this was really bad. I shouldn't have done it quite as far. Oh, well, because it starts going up like crazy at the very end. You can't kind of just graph it, whatever, I'll stop there. But I said instead, if we do this little trick where we say, take the NPV at the IRR, if this IR was a different method, like our little risk premium method, we could have used that. But take the NPV, and the NPV, we said, that thing didn't work very well. I'm just going to press F11 and it's going to make a mess. But the IR, the value goes down, and eventually the value goes down to 0. And if you take the difference between these values, all those difference, whoops. It's time to delete that sheet. If we take those difference, then the sum of all those differences, the sum of all those differences, and it starts negative. You get negative depreciation, and it goes up and down. But then once you put that negative depreciation, if you take the return on invested capital, which I should have told you is the EBIT, in this case, it's pre-tax. You can call that net operating profit before tax if you'd like, and divide that by the investment, which is just the amount you spend on all your CapEx minus all of the depreciation. If you take that, you get the same return. And suddenly, oh my God, suddenly we can evaluate and use this kind of theory to say, are we generating economic profit like McKinsey said or not? And then if we do that, and I put this, I didn't mean to put this in here. I've got to move it. Remember, if I move this out here, we can move it like this. And so now we have a way to benchmark everything. And let me show you what's cool about this. And then I'm gonna stop here as soon as I can. I'm going too long on this kind of stuff. But if you have to make a balance sheet, so this time I put straight line and economic depreciation. And if you remember, we have a little kind of thing here where we can say, let's put a true or a false. So this adjusts this thing to true or false. So I said the very first thing we do is remember we put the start and end. And what I did here, and I'm taking too long on the introduction, so This is a macro, and these macros, I think they're valuable because it says go through each row. I'll let you look at it a little bit and take that start and end. And you know what? I didn't put anything here. And then find the row number you input. So when we do our consolidation here, this is just in Excel. If you put equal row and go to this template model, you'll get the line number for straight line depreciation, economic depreciation, revenues and expenses and all that. And then this macro just takes that thing and makes it into a start and end. And when we make it into a start and end, then you consolidate all the numbers with start and end, and you go over here. So this time we have some revenues that are starting in our first project. We put our second project in, our third project in, and eventually we put all of our projects in. So this profit and loss, revenues minus OpEx, EBITDA minus D and A. This D and A we have to be really careful with. If you have some interest during construction, that's got it. There's some those are capitalized for accounting purposes, and then we have to depreciate those. I purposely didn't. And then we have our EBIT, and then we put our depreciation expense, which could either be straight line or oops, it's did it just a minute. This straight line. Uh-oh. Uh-oh. I've got to, it's going really slowly, I think. Do I have my calculation off? Sorry about this. So I hope, yep, okay. And oh my God. Okay, I made another mistake here. Oh, that's good. I found it now. Okay, so if it's straight line, please come on. No, it's not straight line. Now it's economic. Excuse me if I put positive and put straight line here. Then what happens is, I'll just come down to that in a minute. Then we'll put our cash flow statement in. In the cash flow statement, it's not complicated. Start with operating cash flow. In investing cash flow, if you have interest during construction or fees, which we're going to talk about, we'll put them in next. And then we'll put the amount of debt we raise and the equity we raise. And in project finance, you can take the operating cash flow plus the investing cash flow plus the financing cash flow. Now, if some of the people here are young people who are worried about these exams where they all irritatingly ask for 3 statements, if you set it up like this and you want to go really fast, you have to set up the profit and loss and the cash flow. And then when you go to the balance sheet, everything comes from one of those 2 statements above. The CapEx, the plant is just the last year plus this one, accumulated depreciation, that's from the profit and loss. And then I put our interest during construction on the balance sheet. Our debt balance is our last period plus our issues minus our repayments, and then we make a little equity balance where we add in the equity we issue, and then the income we get from our profit and loss, and then the dividends we get from up here, which is from somewhere else. We should have computed a cash flow waterfall to get the dividends, and then we're really happy, except, oh no, there's a false here. This false. Oh, shoot. Okay. How embarrassing. Okay. Let's put, that's, okay. I gotta figure out what I did there. That was really, really embarrassing. All right. Then but this is the big deal. Then let's take this month by month financial statement and put the month by month financial statement into a consolidated, into a annual statement, and you always use sum if. And it's so easy, especially if everything's the same. We use sum if or lookup. We use sum if on all of the things that are flow items, that are cash flow items, and we use lookup down here. So let's just do one, and then you can copy the whole thing down. So that's why I say sum if is such a big deal. sum if, and then what you do is you go and you click on the entire, all 12 2025, 12 2026, and then F4, lock that. And then you go back to your consolidation and you press F4 two times. And a lot of people have done this. This is kind of, you could do this halfway in your sleep, but you leave it on row 6, but you want to copy the rows down. And then as long as I have exactly the same format, and I think I do, then you just do this one and don't put any F4 here. And then you just can copy it across, and then you can copy it all the way down. Now my format's going to be a little bit off, but who cares? Okay, so that's how fast you can just get a annual amount from the whatever the monthly or semi-annual. You could do this all sorts of different ways. And then once you get to the balance sheet, you put equal lookup because we only want the December balance sheet. So it happens to work kind of nice. You just put this up here. And since we're going to do the same thing, press F4 a couple of times. And then after we do that, we'll do the same thing. Unfortunately, the lookup and the sum if are backwards. And then you press F4 on that. And then you go down, you go back to the monthly model, and you just want the annual, the thing for the last 2025. So again, you just take that whole string, and you can just copy this at least down to here, I guess. And then what I did is I hope that I better do it here, and I copy this one down to this one. I hope that's all working, and then the balance sheet should be balancing except for the last one. That's all kind of boring. Here's the exciting part. When we put all of our projects together, here's what happened. Our ROIC starts really low and then eventually goes high. And again, that thing, and why I just pressed F11 and the thing's going slowly, it starts going up like this. So we can't use oh no, we can't use our McKinsey kind of thing to evaluate this. We don't have any benchmark, any good benchmark. Now, this happens with any corporation. I showed you some stable kind of corporations, but to have a stable corporation is kind of rare. Corporations are either in a kind of declining situation, like a bunch of old things, the GM or somebody, or they're in a increasing, growing things like all these high tech companies and all that stuff. So that's our return on invested capital. But now let's do the cool thing, and I've gone an hour this time, so I'm going to stop right now, and we're going to do some of that Excel. And I thought I just pressed this button. I hope that worked. And here's what's so cool. Look what happened. The return on invested capital is staying. That's because every project we measured with a economic depreciation. And when we do this, we can directly look at this IRR and evaluate whether this corporation is doing well or doing badly. Now, at the very last, I've got something wrong in the very last period. I have to check that. But for me, this is kind of a dramatic result. We can, if we're valuing, so here's the final conclusion. If you're valuing just about any corporation, what you really want to know is every Costa Coffee, what's the return on every little shop? If we could get that and see, are you earning more than your cost of capital on every little shop? And then we take the distortions of the growth rate out of there, then we can really figure out, are you able to earn a good cost of capital in the long run? Okay, and this is now we're going to do something. I don't know, we might, this is going to be good in a way. I might have to push the circular reference off. when I did that circular reference, now you can see this is a big sheet. If we have no circular reference, it takes 52 seconds. No circular reference. If I use the iteration button, it takes 340 seconds because we put a circularization and it's got to iterate around. If we use the copy and paste method, it takes 131 seconds. So we started with 52 seconds. It took 340 with the iteration. It took 131 with the copy and paste. And then we use this UDF method, and it only takes 54 seconds. And we're back to almost the same speed as this. And this problem of large models and circular references is a big deal. So I'm stopping now. That took a lot longer than well, I thought it might take a little bit long. I hope you don't mind that we went through a little bit of theory here. So should Nikolai, would you mind, we don't have to use anything I just want to go through right now a couple of issues. I
Yep.
want to show this corporate finance, how that works and how those formulas work in corporate finance. And then it's good. Oh, wow. If you, very good. We'll just use this one. We don't have to use any of the others. And then let's just, okay, let's, after that, we'll go through this issue of consolidating from a monthly model up to an annual model. That's fantastic. Thank you. So can you go, there's a page, I called it, are you're on the right, can you go to the page called Corporate Finance Theory? Okay, and,
Yeah.
very good. And then, could you, just one second, sorry, this is my phone, I'm just, okay, so I'm gonna pretend I just want to illustrate how this works. And again, I don't know if, Nikolai, if you've ever done this in finance. I suspect that people don't in their very first kind of course in finance. I would think you would do this, but I don't think you do. This is going to be an illustration of corporate finance, and we'll put a terminal value and a holding period and all that stuff in. Can you go up to where it says year and I put 0 up there? Now, that's going to be our starting point. Instead of doing that, could you put equal sequence? And let's pretend, let's make our silly thing where we go up to 500. So we're going to keep it on one row. So you put a comma, yeah, and then start in 0. Very good. I've never done it like that before. See? Okay. And then I want to show you how to do a little bit of interpolation, but for now, let's assume this could be ROE or ROIC. If it was if you have no debt and no taxes, the ROE and the ROIC is the same. The amount you have on the balance sheet is the invested capital on the balance sheet is just the CapEx, it's just the net plant, and then the balance sheet is balancing, so you have an equity on the bottom. So let's just pretend our ROE, let's pretend our ROE is 7%. How's that? So go down in row number 8, and we're going to put a terminal value in a little bit. So right now we're going to just pretend we're valuing our corporation forever and ever, and just put 7% for all of those things. Now, what I'm going to show you is how to use this interpolate function a little bit. And then let's put our growth rate. Let's say we grow at 2%. Okay. And then let's say our cost of capital is let's make it 5.5%. I hope I'm not screwing up this. Okay. And then we're not going to put a holding period in here yet. And I don't know why I put that differently. And then here's the big formula here is, remember, I tried to write it down here. If it's 1 minus G divided by ROE. So it's 1 minus the growth rate, not cost of capital, the G, the 2%, very good, divided by the ROE, the 7%. Okay, I think, does that work? Hang on, you don't need the first bracket. Could you take that first bracket away? Uh,
Oh,
very good.
The first,
The first one right after that one, right, sorry about that. Very good, I love it, good, presenter, it doesn't matter now. So that means that we can, oops, we can have a 71% dividend payout ratio, and to grow at 2%, we have to retain whatever it is, 29%. And let's just, the book value we would take, the book value, if you think about this, what it really means is the amount that you've invested in the company. Let's just say that's 25 per share. We're going to do everything on a per share basis. Okay. And now let's actually, could you take those last two 25s away? We'll see why in a minute. So that one, I'm a little bit inconsistent the way I did it. So let's go to the closing balance. This is our equity account. Go down to is 25. We start with 25. That's the amount we've invested in the company. And then the opening balance, very good, is equal to the closing balance. And then you go down, and the income you get is the opening balance that go up one, and you multiply that by the ROE. That's, and whenever you do a little exercise like this, it's really good. You always take the opening balance to start with and assume all the cash flows occur at the end of the period, because the Excel NPV is always that. And you take that one and multiply the dividends or the earnings multiplied by the dividend payout ratio. That's how much you pay out. And that's the basis of the cash flow. And then the closing balance, you can press alternate equal. Is that okay? And then you can just take that whole thing. How about pressing Shift Control Q and then copy it for the whole? Very good. And then take that last one and copy it all the way to the very end. Okay. Uh-oh. Oh no. This time, I'm sorry, we have to copy that. Can you, I suppose, let's take that last the what's in H all the way from H down to line 14 and just copy all of those. That's kind of our terminal value, and we can say that. Okay. And then let's get
Hi,
the value.
sorry, Ed. For the closing balance, do you less dividends? Do you minus
Oh,
dividends?
yes, of course. Thank you. Oh my God,
Okay.
how stupid. Oh my God. Oh, thank you. Oh, excellent. You don't know how much I made that mistake, so you could, oh, that's fantastic. Thank you. Oh, man. So let's take the PV of the dividends. Let's go to period 0, and that's our theoretical value. I don't care if it's a high-tech company or NPV instead of PV. Okay, and then use the cost of capital, there, and then just take all of those dividends, just the dividend line in line 19, up one. No, not the closing balance, the dividends. Okay, very good. Very good. Okay, and don't worry about the hashes. That's our formula. And then if we wanted to compute the PE ratio, if it's a forward PE ratio, we would take that value, put an equal sign, take that value and divide that by the earnings in the next period. Very good. And if we took the price to book ratio, we would take that value up there in one more above the value divided by the book value of 25. And very good, that works. Okay, that's our price to book ratio. And those values, that's this McKinsey idea, they come from all of that. Now, could you do, I did something bad. Could you go up to the ROE and the growth rate and the cost of capital go forward, just to the next one. No, just column G, just put an equal sign, go back to the 7%, press enter, and then do that for the next three, just so the same, and then copy that all the way across. Okay, so what we're doing now is, so if we wanted to get our formulas, the famous formulas, if you go down, let's go down next to the PV of the dividends. If you go up to that one, if you just take that 1.25, put an equal sign, take that 1.25 and divide it by the K minus the G, open the bracket, and divide it by that one minus the G, okay, press enter, we get the same thing. Or if you go down to the next one, if you put a equal sign and take this is the famous McKinsey formula, which they don't ever do like this because it's too easy, maybe. You just take the earnings. How about no bracket at first, maybe? Yeah, that's fine. And multiply the earnings and then open a bracket and put 1 minus, open a bracket, 1 minus G, the G divided by the ROE, and then close that bracket and divide that whole thing by the K minus the G. Open the bracket, very good. Okay, and that's their principle, and the PE ratio, excuse me, that should have been we don't take that E away on the very first, that G18. You don't need the G18. Take that, just that one. Okay, I hope. Let's see. Good. So you can get that. And the price to book ratio, I don't show you the formula for that, but you can, the price to book ratio is put an equal sign, and that's open the bracket, and it's ROE minus G. So it's the ROE, the 7% minus the G, and then you put close the bracket and divide that by the cost of capital minus the G. So all of these, if you had a company and everything was, all was the same, you could, everything's totally fine, and you wouldn't have to make a financial model or anything else. And that's what I was trying to demonstrate with, if we knew the ROIC of a company and knew the cost of capital for a company, then everything's already there. Let's make it a little more complicated, though. Could you go and I should have practiced this, but this is great doing this for me. Let's make a gradual increase or decrease in the ROIC. So let's just do one by one. So to make a gradual increase, let's say that in year 5, we think our company, this is kind of a whatever, Nvidia or somebody, it's right now not earning that great a return, but it's got this monopoly chip and nobody's going to be able to copy that. So let's make that go up to, how about let's make that go up to 15% in year 5 and then gradually stabilize at 10%. Who knows? Okay. Now, if you do that, now the whole thing doesn't work, and you can see that why? Oh, just a minute. If we do the NPV of the dividends, how about, yeah, we'll leave it like that. The point is that in column F, that was the true value. But when we use that formula, I see, can you copy those formulas? Can you just go down and copy those formulas to the next, just to the next? Yeah, that's okay. I think because here's what I wanted to do. Yeah, just, how about, yeah, leave that for now, leave that for now. Leave that for now. Actually, that's kind of cool that you did that. Go up, and this time, what I really wanted to do, excuse me for doing this, could you go down? Could you insert, 4 lines right there, insert 4 lines, okay? Okay, and then where it says copy ROIC and just copy from line 12, go across just to, yeah, just, how about, and the growth and the cost of capital. Take those 3 and just copy them to column H, only to column H. So go forward, copy those and put those upstairs. And this time, so I wanted to just change it in year 5. I didn't want to change it in year 1. So what you could do is go down to line 12 and let's practice our lookup function and go to the 7%, and put equal lookup. And this time, what you're going to do is go up to row number 2. That's what we're going to say. Let's start, and let's, in row number 2, and then put a comma, and then I guess we can do this. Click on the entire line 7. I guess that will work. The entire line 7, it won't work. And then put a comma and click on the entire line 8. And that would, what will happen then, and press enter. Now, can you delete that in I8, go to that 10 and delete the rest of the 10s? Just shift control right, just shift and delete that. Very good. So what we're doing now is, if you look at that lookup and copy that shift control R, we're saying, okay, and you have to do it one more time at the end here, because the way that shift control R works is it looks up and finds that 7% in, yeah, shift control R again. So it suddenly popped up to 15% and then it pops down to 10%. And now that you might not want to do it like that. You might want to say, oh, let's gradually go up to, when it hits year 5, let's gradually go up to 15%. So not just pop it straight up. So what we'd want to use is a interpolate function. And you can kind of do an interpolate function manually if you put Alt EIS. Just try pressing Alt EIS. Alt E hands off IS. And then you kind of can do a linear or growth thing, but that's all manual. It's just a pain. I can't do that. Cancel this. So instead, we have to find an interpolate function in Excel, and I don't think you can. Not an easy one. So instead, what you do is you first go to the Developer tab. And then after you go to the Developer tab, then you go to the macro security. And can you hit that last one, which says trust access to VBA project? I don't even know exactly what that means. And then you press OK. And then what you do is you press Control Alt C, like we're coloring the menu. And then you see it says import, you see the purple area, it says import functions. These are called user-defined functions, and I'm going to do a little bit of that if we have time. If not, we'll do it next time. Press import functions. And then I say, well, let's take it now. If it's a macro is just the one we've been using before with sub and everything else. If it's a user-defined function, so you can create your own sum function that doesn't screw up with NAs, or you can create all sorts of things. But you see where it says target file down there. And then you click on that and put that session 8. If it's a regular old macro, you can just call it from one thing to the other. If it's a user-defined function, we have to actually copy it into our own sheet and hit that one that says retrieve interpolate lookup function. And then once you do that and press OK, I hope that works. And then instead of that lookup, put equal, right? When you're stepping, put equal interpolate. And let's just use the interpolate lookup. There are different ways to move from one to the other. You can do it on a straight line or a growth basis. Let's use that one, and it works just like the regular lookup. So go to the 0 up in line 2, put a click on the whole line 8, and then put a comma, and then click on no, I'm sorry, the whole line 7, and then the whole line 8. Excuse me for that again.
Oh,
Whoop.
that's fine.
No problem, no problem. Okay. Perfect. And then, so this time, Shift Control R, and then why don't you do it again? Oops. Yes, it worked. So it gradually went up to 15 and then gradually went down to 10, and then it just stays at 10. Okay. And now we can look at our, and that's really what you're doing when you make a big corporate model. You're saying, okay, what's happening to the rate of return on this company? And mathematically, there's nothing that we did wrong. If you go down now, you can kind of see what happens. And now the value, well, that if you're looking, it's really, you almost this time, could you this time go to column F and just copy that thing all the way across, shift down again, okay, and do the same thing on that one. Good. So now we can see what happens to the PE ratio as if the PE ratio is, it's supposed to be high and it's going down. The reason it's going down is because the earnings are going up, but the value is not going up as much as the earnings. So if you take the value divided by the earnings, when the earnings go up, it's ironic, the PE ratio goes down. And then we have that. Now, if you would have can you just do one more little thing? If you go all the way up to the top where you put that little interpolate thing in, if you put, let's put the cost of capital to be, let's go and make that ROE 7% all the way across for the first three. And then Shift Control R, and then you put the cost of capital to be 7% for the whole thing. Go up, okay. And then if you go down now to the bottom, if you can see that, oops, oh no, just a minute. Oh, the cost of capital, go up to the cost of capital and do the same interpolate function for the cost of capital. So you just, yeah, I think if we just do it by hand, equal interpolate, and again, this is, and you click on the 0 up in not the whole line, this just the 0. So we're looking up that 0, and then that lookup depends on that year, and then put in the cost of capital in line 10. Whoops. Very good. Oh, how you did that, that's fantastic. Then if you go down, now the price to the book ratio is the same every single period. And I use this, it's a very radical thing to do because I don't use the CAPM, it's just saying, well, I use, but the CAPM sometimes. But this says, if we had a company where the price to the book ratio was 1, and if we knew the return on equity, then we'd know the return on invested capital. Of course, you can't find ones that are 1 all the time and 1 forever. Let's do a little bit of an exercise with the growth. Let's do the same thing and go up to the growth rate. Let's now put back our cost of capital to whatever you thought it was. So when you're really evaluating a stock, this is what you're doing. And then let's go up to the ROIC and pretend we have this company that's gonna start it. Right now, these companies, but they're gonna go up to 15% in year 5, and then they're gonna gradually go down by the time we hit 7. Let's put 11%. So they have some inherent beautiful thing that they can earn 11% forever. That's what we're really doing with our corporate valuation. And let's put the growth rate to be 15% first. Let's make that growth rate 15% and then go down to 10% and then eventually go down to 3%. Whether that ever happens, you know, go down. If you looked at Mike, oh, very good. I forgot to do that. Oh, thank you. Ah, thank you. Oh, it's so good that you're so, okay. Then we should see a really, really high price to book ratio. Is that what we see down at the bottom? So that's how you can explain these really, really high price to book ratios and price to earnings ratios. And if you really did the valuation, once you hit period 10, can you see how everything stabilizes? That's our idea about a terminal value. If we could ever really figure out what a terminal value is, and I suppose I'm not gonna, yeah, if we wanted to put a value over the holding period, I suppose we would do this. This would be like a, a, a corporate valuation. You could go up to the top and let's put our terminal value period up there. Let's go all the way back to the beginning. Let's make our terminal year 10. Oh no, I'm sorry. Let's do it the way we've been doing it before. Escape. Could you go between E and F, insert a column right there, and let's in E3 just put that as a flag variable. So I'm trying, maybe I'm showing, I hope, and let's say that just put 10 there. That's our terminal year. And then go forward and just put an equal sign and go up to G and put equal to the 10 and then lock that like we've been doing before. And I suppose this time we can even and shift control R. And then let's do the holding period. So then we have a true just in year 10 and the holding period is very good. Put 10 there too. Very good. I'm sorry. Assuming that, yeah, and just put an equal sign, go up to that 0 and make it less than or equal to 10. Okay, so it's just any corporate model or valuation model will have the same kind of thing. And then if we have these things that are moving up and down, this is what we've just done, I would argue, is make a kind of DCF corporate model. We're making a valuation model, but I'm trying to show you that that depends on what, at the end of the day, it depends on what kind of return you're making and what kind of risk you're having. And I haven't changed kind of the cost of capital. You could certainly argue that once you hit some kind of mythical stable period, which God knows, I don't see how you ever hit something like that, you have a lower cost of capital, but let's not even worry about that for now. Let's go down and just do our valuation this time. And so let's put, how about go down and let's put, what do we do? Let's put cash flow and earnings over the holding period. So I hope I'm gonna do this okay. And let's go down and put I think let's put our opening balance. And then I have this is a little bit embarrassing. Let's go down and get our let's go down and get our net income. We'll do the same thing. And we can just take that from above, can't we? And then below the net income, put our dividends. I don't know if we really had to do this. And then put our closing balance. And then then we go, if it's a DCF, go down, and then you put, put, maybe skip a line and put dividends equal cash flow. So, actually, then we didn't need that. In 31 to 34, let's delete that. I'm so sorry about that. We didn't need that. We just need our cash flow over our holding period. So just, and then below that, oh, good. And put dividends up there. That we need that's what you're doing in a little DCF analysis. And then below that, let's put terminal value, and we can use anything we want for the terminal value. In our term, how about let's go forward one and let's put our PE, go down, just put PE ratio, and we'll just take that PE ratio we computed from that formula and then put earnings in terminal period. And then we'll put value in terminal period. So, you have all of these terminal period formulas. And then let's go down and put skip a line down, and we'll put total cash flow. So our total cash flow will be, let's go up. I hope I don't screw this one up. Go up to line 31, and just go forward and put a equal sign and just take our dividends. Oh, we have negative dividends. That doesn't matter. A negative dividends means to grow that fast, we have to issue equity. And just take that, but this time multiply that one by the holding period switch. So I guess for me, we're just showing you use exactly the same kind of things, whether it's corporation or not. And then what we could do is, now if you go forward, we don't have to go, our model isn't going to go to 500 years anymore. Our model just is going to be a shorter term period, of course. Okay. And then you go all the way back, and let's put our PE ratio in our terminal period. So go down and take that PE ratio and multiply that by the terminal period. So this time we're only caring about that for the terminal period. Okay, and then you copy that, and then you put the earnings in the terminal period. Do the same thing. Get the earnings from in line. Very good. Multiply that by the terminal period. Okay, and then so the value in the terminal period is the I'm sorry, it's just the PE ratio multiplied by the earnings. PE times earnings is equal to that. Now, what people realistically do is they make some adjustment and they use comparable companies and all that stuff, which I think is a little bit crazy. So now let's get the total cash flow, which is just the holding period cash flow. So go down to line 37. It's the holding period cash flow plus the value in the terminal period. Okay, very good. No, downstairs, just on the bottom, that value in the terminal period
Yeah.
in line 35. Very good. Plus,
And then,
sorry.
just this.
So
Is it multiplied by something or sorry? I
no,
didn't catch that.
we already multiplied the PE by the E, so we already got. But add to that the dividends. Add to that on 31. That's a DCF analysis. And then you put the NPV of that, go down and put the NPV of and then you use the same discount rate. We'll use the same discount rate. So we just need that in year 0. So just put equal NPV, and that's a little bit what we did already. And take that 5.5, which that if we did a change in the value in the discount rate, it'll be a little bit trickier. But take that and take that the line 37, the whole line, shift control. Oops. How about let's only do that over the first 10 years. If we have that divide by 0, I don't know what happened in that very last year. Okay, and that 107, Now, oh shoot, if you go up a little bit higher, can you go up to can you go up and go up? What did we do in down there in line 26? What's in line 26 right now? That should have been uh, go down. That should have given us the same valuation as the other one. And just a minute, can I see my mistake right away? Can you take that value in the terminal period and multiply, just a minute. Right now, at present, we have, did you change anything or did it just change? Can you
No, I
take
just
that? Very
I
good.
took away the 0.
Oh, I see. Oh, great. Oh, perfect. And go up to that value in the terminal period in line 35 and multiply that by 1 plus G. So take that whole thing and multiply that by, open the bracket, 1 plus that growth rate, which is very good. And then press enter. And that only really matters in that last year. And now we get exactly the same thing. So that's that little thing. That's a DCF analysis. And I'm trying to show you how to think differently a little bit. And I doubt that if you've been taught the DCF analysis, you've probably got to go to Amazon.com, get the financial statements, go through and compute every single little line item. But what you're really at the end of the day doing is computing that return and thinking about the long-term ability to make a return. And you can see that all the value is in that terminal value. The little dividends at the beginning don't mean anything. So if you're looking at one of these high-tech companies, anybody, that's what we're doing. Enough of that. We still have some time, but what I'm going to now do, I suppose, is we'll have one more session and then we need to take a little bit of a rest, maybe. This is fantastic. I can't tell you how much I appreciate just a few people come here, because then we make the videos and I think more people even look at, I don't know if they look at like 1 minute of the videos or something, but it's great that you're doing this. Let's go to the template model now and show you, we're going to go back to project finance. And here's our problem in project finance. If you go, we're going to find the debt structure in project finance. Okay. And if you, for that debt sizing, now what I did is I cheated. So let's, and maybe, how about, yeah. Do you see where, yeah. Right now we have let's even start with line 108. Line 108 just says, okay, if you notice that we started, the project began operation in July 30, in July of 2025. Is that okay? Can you see that one? And then we just started counting. We made a counter variable that just takes the last period plus 1. So that just counts how old you are in months. Okay, and then this one, if you see it's 12, we should talk about this. If you take that 1, it goes from 1 to 12, and if you want to count that in, put life counter dash years for now. Go in the title in 109, just take that and make it years. The title, it just says periods in C whatever 109, that should say life counter in years, put dash years. And so what we're doing is we're taking the 1 divided by 12, that gives you 0.0833. 2 divided by 12 is whatever, 0.16 or 17. 3 divided by 12 is all the way lower, but then when you get to 12 divided by 12, that's 1. So if you take that number above and divide it by 12, you get a fraction, but then you go all the way to period 12. That was perfect what you just did. Go just forward over to the year, and then it's still 1. But when in 13, that's 13 divided by 12 is 1.0833. And you round that up, and that rounds up to 2 this time, and you put a 0 to make it round up. So that's how you just convert a period to a year. And that's a very common thing you might have to do. And that if it was a semi-annual model, instead of dividing by 12, if you want to count the semi-annual periods, you'd use 6 instead of 12 and so forth. And then if you go now the debt repayment flag, what we did there is we said, oh, we have a debt repayment of 23 years. I think if you go to F 110, can you just, and press, remember control in that square bracket next to the P, control in the square bracket. And that's what I put in different debt lengths. And I think we're on project number 1. This time we're not on this one. If you go back to that template model, press F5 to get back to it. You see the number 1 in E1. If you press that to be number 2, then go that 1, just make it number 2. Then it'll take the second project instead of the first project. That's the mistake I had made. Okay, so now we have a 20 period debt repayment. And then here's the problem. If you go down to the next one, I said, well, and this is the one, this drives me crazy a little bit, but if we can you maybe put it back to project number 1. So there you go. And then, so that one, remember, we're 1 July 2025, and that means if I say, when do we have to repay this debt? Well, I said, okay, I've got to count on my fingers. I'm sorry, I really do. I've got to go, the first repayment we're going to make is not we're not going to make a repayment on 1 July 25. We're going to say July, August, September, October, November, December. That's 5 months, not 6 months. And that's a mistake I always make. Now, I don't know why it does that. Don't worry about that. And then you go to the next one, June 26. You see what it says that? That's when we're going to make the next repayment. In our model right now, we have so I didn't put anything there. That's a blank kind of line. I just made that a blank line. We didn't do anything with those yet. But if you go down to line 112, I just put the month number. So that's just equal of month. If you press F2 again to show everybody what you're doing, you just get that month number. So, and then if you go down, we're going to make our repayments, that 12 and the 6, those are the months we're going to make our repayment. And it's that 5 instead of the 6 that drives me crazy. But that's because we're counting that very first month. It's from the maybe beginning of the period. If I use the end of the period, maybe I wouldn't have had to do that. And then I just use the OR function. But look at all that crap I have with the things. Let's do that ourselves. Let's just do that ourselves. Put equal OR and just open the bracket and go up to that month number. Oh yeah, and put an equal sign and then go to that 12. So we're going to repay in that one and lock that and put another comma and go back up to the number 1 and put an equal and put the 6 and press F4. And then you just press enter and copy that all the way across. Okay, now once you've done that, The problem is it has a repayment during the construction period. If you go forward, it has a repayment during the construction period, and we don't want to, that last one is that's during the construction period. And so then we want to also make this formula only apply to go back. And we want to make, so let's go back to the beginning. We only want to make this apply to the operation period. So put an and right after the equal sign, put an and. Okay, and then go up to the operation period in line 7. Now, this is another thing. I think you need oh, you can do it like that. Very good. Press enter. That works just fine. Okay. And then you copy that across. And when you do that, just a minute, if you go forward, where's our first repayment? When does our first repayment occur? It occurs in December of 20. Did that work? Yeah, that worked. Okay, and so we just have a little flag for all of the repayment period. Okay, and then how about let's try this? Can you go down to that thing called the repayment counter in line 116? You know what we'll do? Let's go. You see where it says target debt service in line 120? Go down to target set. So I'm going to go back to what we just did. Insert a line just below that target debt service. So that's, and call that debt service, call that target debt service above, let's call that target debt service monthly. And then below that, we'll put the target set debt service periodic or semi-annually, what we're really doing. Okay. So if you okay, and now if you go forward, let's just look at what happens. Can you go a little bit forward to where we have some of the numbers? So what we don't want to pay our debt service, either our interest or our repayment. We only want to make that repayment. And if you keep going forward, now I cheated with you. Do you see we have a true there? And do you see that what I did in that last repayment counter line? Can you just step on that last repayment counter line in line 16? If you press F2, that just goes back and then we add one as soon as we hit that true. So press enter. So that still is a repayment of 1. And then if you go forward to the next column, that starts with repayment of 2. Now I'm going to go backwards and show you how that works. But if you can set up a nice little counter like that, so we don't start this, go forward, as soon as that's perfect what you're doing, Nikolai, go back to where the 1 started. We have to start, that's the hardest thing I have to do, is to start in the right place. We want to start counting our debt service in that very first period. And that's painful. To get that counter to work for me is it looks really simple right now, but I'll tell you, it took me so much time to get that. But let's go down and use that counter, and then we're going to go backwards and see how it works. So if you go down to where it says debt service annual, in that line, go all the way down, I mean semi-annual in line 121, go all the way back to the beginning. And here's the trick. You go equals sum if. And when you use sum if, the sum if, it's like it takes the month, remember, or we talked about how that works. And then you click on the entire line 16, the entire line 16. No, 116, oh my God, sorry. And then you say, okay, I'm going to sum it for that one, that's either going to be 0, 1, 2, and I'm going to sum it across all of those forward periods, all the way forward. And you put a comma and go up to line 116 and go to K 116. Just to K, one number. So I'm going to sum it when it's 1, and then you put a comma, and then you click on the entire line 120. And if somebody says, oh, that's illegal somehow, that's crap, press enter. And that's step 1. And what that does is if you go forward, Shift Control R, if you go forward, now what it did is if you look at that target debt service, if you look at that target debt service inline 120, just press Shift and select Shift just to across 6 periods. Press Enter, Shift and right, just across 6 periods. Is that right? And then, whoops, yeah, I think, sorry about that. There, stop there. And that's the 111. So we summed it. You see what we did? We just summed it across. And if you keep going to the next one across, if you keep going across, then it sums it for the next period, and then it's always summing for the next period. And then you go down, you go backwards, and then go all the way back, and then just multiply that, leave that formula there, but at the very end, multiply it by that thing called flag for the repayment period, which is in line 115. So all that's just a 1 or a 0, not from the counter, but from the other one. And if you go forward, so it just plops it only in that period. And for me, very good, you're testing it out. Fantastic, okay? And you can do, basically, once you have this set up, we can do a whole bunch of things with this. Perhaps let's go down. Do you see where it says target debt service over the debt repayment period? Can you just make line 123 right now? What does it have in there? Go forward. It has use the 121 instead of do the same formula, but press F2, use 121 instead of the next one, press enter. Okay, and now we're just getting our debt service only on the whatever on the in the 6-month period. And then if we computed the DSCR, well, we should do exactly the same with the cash flow. We'd accumulate that cash flow. So could you go to line 122 and put CFADS? How about let's do that in line one, go up to 120 and insert in 120. Let's do it just underneath. So we're going to do exactly the same thing, put CFADS. Yeah, just, no, that's fine. Put CFADS semi-annual, okay? And we'll do the same thing. And then you just have to get, very good, oh, perfect. Go forward and just put equal, remember what that was, sum if. The trick is the sum if. It's the sum if trick. You click on the entire repay. Oh, very good that you got this right away. And then you go up and just put, no, then you go down. You use the same 116. We want to sum if, not, and just one single, we're just going to sum if it's 1, if it's 2, if it's 3, and then you click on the entire CFADS in line 119. And then you're not finished, multiply that by that repayment flag. Press enter and Shift Control R. Okay, so now if you go down where it says CFADS over the repayment period, use that CFADS that you just did. Okay. And so for me, this is a little more advanced, but it's becoming much more of a common problem where you make a month-by-month model And I think then you can do all your solar stuff or whatever, detailed seasonal stuff. Everything's monthly. It's pretty easy to do until you get to the debt. And if you go down now, we did this periodic interest rate, and I think we can do everything okay. Keep going down. And then we computed the present value of the debt service. Now that present value of the debt service, I hope it still all works. If you press F2, oh yes, use the I think we can use it. Oh yes, we're using now. We're using the semi-annual stuff, right? Press enter. Okay, and what we'll do is, so we left that formula the same. Could you go down to the debt schedule? Go down a little bit. And in that debt schedule, do you see where it said we have the debt issue and the debt repaid? Now that debt repaid, it should have been the go back to the beginning. Oh, I did this differently. Let's just do it like this anyway. You would take the CFA ADS over I'm sorry, the debt service from the DSCR. So take line 163, I hope. If I'm not getting this correct, I'm just gonna fix it later. And then you subtract the interest expense. And then we do the interest expense, can you go down, go to the very next one, because we're gonna have to do exactly the same thing on the interest expense. We're gonna have to accumulate that, press enter. Okay, and then go down to that interest expense and put, yeah, insert a line and put interest expense semi-annual. And you go forward and put equal sum if again. And you go up and click on that entire range on the repayment counter, and then put a comma, and then go up to that same repayment counter. Now you're an expert at it, and then go all the way down to that interest expense, and you want to just plop that interest expense into the, very good. And then after you do that, you multiply it again by the flag. Okay, so oh shoot, we got to do this only for that debt repaid. Could you go up to that debt repaid? Don't worry about that circular. Down to the blue line, the dreaded blue line. Go down to that dreaded blue line. And on that debt repaid, put it up in line 168. Go down to line 168, go forward and put an if, not a, that's what Brian was kind of trying to say, put an if, escape, leave that first, but after you leave the equal sign and then put right after the equal sign, put an if. I'm sorry, leave the formula and then in the, I hope we don't, so right after the equal sign that's already there, put an if statement. Sorry, so very good. And then go up to that operating period in line 8. That's a flag. No, I'm sorry, the line 7. And then put a comma. And that just changes it. That just takes it away. Press enter. Shift Control R. Oh, please. Okay. And then I don't think we have a circular reference. Can you go forward to the first operating period and see if we don't have a circular reference? Yeah, and so there do you see what we're doing is we're repaying it, and now we better copy that interest semi-annual all the way across. And can you see what we're doing now is for me, this is a little bit advanced, and it took me literally years to try to get this little stuff right. Oh no, I'm gonna have to fix that later. Oh shoot. I know it can be fixed. Oh, Could you do the same thing with the interest expense? Put go back and go all the way back instead of using the multiplying in the interest. Go down, go down one and go all the way back. Do you see what it says 115? Instead of multiplying by the 115, take that 115 away and put that as an if statement in the beginning. So put right after the equal sign, put an if, and then put that 115. No, the 115, the repayment flag. Okay, and then put a comma. Okay, and press enter. And shift control R. I hope this works. If it doesn't work, I'm giving up on it and we'll put it in there. Is there, it doesn't seem like the threaded blue lines are there anymore. How you would know that you're supposed to put an if instead of a multiply, and you save the file, brilliant, absolutely brilliant. How you would know that, and if you go forward now, I'm afraid of this. I'm really afraid of this, but hopefully the ending balance will go down to zero. If it doesn't go down to zero, we're going to finish anyway, but that's the idea. And with, oh no, it didn't. I'm going to, okay, I think it's time for an interruption here. The debt wasn't fully repaid in the other example. Now, if I go through this a bit slower, I think it's time to go through this a bit slower. We needed we have this repayment flag that uses an or statement. We take the COD date and we subtract 1 month from the COD date and we make a flag for that single month. We then we get our final key little flag for the date of the repayment, which is 1 or 0, and it occurs, but it better occur every single 6 months from the date from the date just before. Here's the COD date, here's the COD date, here's the 1 month before the COD date. So we start here and we start with our repayment flag. No repayment flag here on the first date. We've got to get one in here, so we put this one flag for the date before the repayment date. We get this, and then we do something really big. We go backwards one. We better do this again just so you can see. We go backwards one plus not this one, but backwards one. It took me so long to get this. I'm convinced it's right. And there's a little counter, and you make sure you have 1, 2, 3, 4, 5, 6. Let's go to the next one. And notice this ending period is right at the flag date. So if we have a sum across these ones, and then we multiply this sum just by this one, that's how we really use the sum if, excuse me. And then we go 1, 2, 3, 4, 5, 6. And then we go up here, 1, 1, 2, 3, 2, 3, 4, 5, 6. And then we go to the 1. On and on and on. Okay. Now the thing I made a mistake was we had a periodic rate, which is month by month by month, and this if you thought you were fancy and would be whatever, you could have said, oh, let's take 360 days in a year and let's figure out how many days there are in each month and adjust it to get a monthly accrued interest. Okay, I didn't. I just divided it by 12. There's our annual rate. We just divided by 12. But it turns out when we do our interest rate index and we do this analysis when we want to get the present value of all the debt service, and I use a present value factor from this interest rate index thing that I've talked a lot about. That's just basically present valuing when the rate changes over time, and you have to remember because this. And I think almost always, I have a tough time thinking about situations where you just use 1 divided by 1 plus the interest rate. I'm blabbering. And then we're going to do this for both of them. And then we said, okay, we take the total funding requirements that would have a circular reference. I took the circular reference out, and we take 80% of that. So we've got the present value of the debt service, which is cash flow sizing, and the debt to capital, which is, I'll call this secondary, just to be the skin in the game, really. Okay, I'm taking my time on this. And then we pick one of the 2 debt applies. Now, the big thing that didn't work before is I didn't, and I'm going to do this by hand again, and I'm going to show you on the same screen what we do. We put sum if. I think I should demand, I can't do anything like that, that you practice this. We start with a range, and you could use sum if S2, I suppose, and then it would be maybe more logical to you. And then we click on that. That will sum it across these 1, 2, 3, 4, 5, 6, 2, 2, 2, 2, 6 times, 3, 3, 3, 3, 6 times, and then we multiply that by our little flag up here. So if we put the flags right in the same order and then do this, we get, oops, I don't have generic macros open. Okay. We get our answer. Now, okay, once we have this, I suppose this time I put a little flag that says, let's take the minimum of the 2 debt sizing methods. And if the debt to capital is lower than the whatever, it's constrained, the DSCR method is constrained, then we're going to name it a debt to capital, otherwise DSCR. And I guess it's a little bit slow, and then I just put a little flag that does the same thing. Now, if it's the debt to capital method, we could spend a whole lot of time on this, but the DSCR, if you have this much debt, but are using the DSCR of 1.2 up here, if we're using this, we'll repay the debt too quickly. So what we can do is have a higher DSCR. A higher DSCR allows more dividends. It's better to use a higher DSCR for the equity investors than a low DSCR. How confusing is that? But it's absolutely true. So now we're going to use a 1. Let me just see something. 1 point. We have total funding 432. Okay. We're going to use, sorry, I'm just going to think about something else in a minute. So we have our total debt, which is here, and we spread that over the sources of funds. And then we have our little check, this is a key check to make sure that we issue and we repay the right amount. And when we do our whole repayment this time, come on, we're doing it month by month. It goes to 0. How exciting is that? Okay, so that's the thing that I had to fix a little bit. And this now, this file will be, by the way, the file we'll use for our next session. Okay, so that will be session number 9, when we're going to finish up some of these issues with circular references and other things. Now, before I just finish with this little interruption, let's pretend that we have a debt to capital. Now, how about this? This is project number 1. Okay, so if we go up to project number 1, maybe let's make the debt tenure 15 years instead of 35 years. If we make that 15 years, okay, and now the just excuse me. Now it says that the method we're using is the DSCR, or the cash flow method, maybe. And if we had used the DSCR for the debt to capital, we would have used this. And I should have said it's if this uh, true, which we're using the debt to capital, we use this one. Otherwise, we go back to our regular old DSCR like this. So we have two different methods that perhaps we'll talk about this a little bit in our next session. You notice that's now we set our debt based on the CFADS, on the yes on the cash flow and the DSCR. Oh, we even have a little test of the closing balance down here, and we make sure it works either way. Okay, and I think that's enough of our interruption. There was some problem with that PV formula. I'm going to fix that like I do all the time when I put this together, and we'll fix that. That is in general the problem. And it's a pain. It's a little bit of a pain, but it's much more common and a little bit advanced. Now, I just want to do one thing before we finish. If you go up to that flag was a pain. I didn't show you the end part of the flag. The problem is we had to start counting. So do you see where I had the repayment flag? We put that true false. And then if you go down to the next one, I had to say, let's take the month before the month before the COD, and we've got to start counting from that month. Otherwise, it'll put a whole bunch of zeros. So if you go to column H and just put a sum, Shift Control V for Victor in column H. Okay, and there should just be one flag. That's just one single flag. We have to add that flag. And then the final repayment flag is, if you go down, press F2, you take that number the repayment flag in line 113, which was just the or and the and you have to add that little other adjustment. If you don't add that little adjustment, it's horrible. So that's what that final flag. And now if you go forward, let's just go. So we have with July 20, we started our flag in July 25, which is I'm sorry, go back to the last. Oh yeah, you're right. Sorry. No, would you mind going backwards just to see where that one right there, that was the pain. So before that it was 0, and then we want to start counting in the very next period. And if you go down, if you press F2 on that one, you see you go backwards. You don't count from the same thing. You have to go backwards when you count. If you don't do that for me, it doesn't work. I'm not even explaining why exactly it works, but if you go backwards one and start counting from that one, then you can get that repayment counter flag. And that repayment counter flag was the key to doing all of that stuff, that converts from semi-annual to annual. So, oh God, oh, I don't know why. You're amazing to do this. And I think if you can start showing this, you'd be amazed. You'd look at these fancy people who do these enormous models, and the formulas they have to do these kind of conversions, that just that can start driving you crazy. But if you can get it down and just do it with one little sum if, for me, that's an important little thing. Thank you again for doing this. Now, can I just ask, we don't, I don't know how many people are left even. That must have, for a weekend to watch this is just amazing that you're doing this. But can you email me if you want anything? I think the next session, let's have a session if it's okay next week. I'm gonna go through this issue with the circular references and show you this UDF thing. I wasn't really going to, but it's not, I'm gonna try to make it reasonably easy. And if you can kind of, for me, the two gigantic problems with project finance models are this kind of getting these flags exactly right. That's a big one. And then we've started to see you can't get around the circular reference, and it's the sin of project finance models. And if we can do this, start to do this in an elegant kind of way, you can be better than the rest of these people, I think. All right, thanks so much. Any other comments or